Welcome back, my friends. As you know, we have all been waiting for the recession that never seems to come. But, investment bank Morgan Stanley credits Bidenomics for much stronger than expected GDP growth. President Joe Biden's economic policies drove an unexpected economic surge that has forced Morgan Stanley to make a sizable upward revision in its GDP forecasts. Biden's 2021 infrastructure bill has created a boom in large-scale infrastructure, wrote MS analysts, while domestic business investment is rebounding, led by manufacturing. What does it mean for the economy? And, what does it mean for the future of the United States? But, before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. And, before we continue, a word from the sponsor of this video. Today's sponsor is InnerLife.com, creator of the InnerLife STS system. InnerLife STS is a cloud mobile platform for mental health care and its integration with primary medical care. InnerLife STS is designed for assessment, data collection and analytics, documentation, and progress tracking. InnerLife STS creates and composes conceptualized narratives and builds them into professional-grade reports. These reports are designed for use by mental health professionals, primary care physicians, justice system professionals and universities and include mental health assessment reports, mental health treatment reports, and treatment progress reports. And InnerLife STS uses doctor-selected pseudonames for all patients. So, only the healthcare professional knows the patient identity. Morgan Stanley is crediting President Joe Biden's economic policies with driving an unexpected surge in the U.S. economy that is so significant that the bank was forced to make a sizable upward revision to its estimates for U.S. gross domestic product. Biden's Infrastructure Investment and Jobs Act is driving a boom in large-scale infrastructure, wrote Ellen Zentner, chief U.S. economist for Morgan Stanley, in a research note released Thursday. In addition to infrastructure, manufacturing construction has shown broad strength, she wrote. As a result of these unexpected swells, Morgan Stanley now projects 1.9% GDP growth for the first half of this year. That's nearly 4 times higher than the bank's previous forecast of 0.5%. The economy in the first half of the year is growing much stronger than we had anticipated, putting a more comfortable cushion under our long-held soft landing view, Zentner wrote. The analysts also doubled their original estimate for GDP growth in the fourth quarter, to 1.3% from 0.6%. Looking into next year, they raised their forecast for real GDP in 2024 by 0.1%, to 1.4%. The narrative behind the numbers tells the story of industrial strength in the U.S., Zentner wrote. Morgan Stanley's revision came at a pivotal time for the Biden White House. The president has spent the summer crisscrossing the country, touting his economic achievements. Together we are transforming the country, not just through jobs, not just through manufacturing, but also by rebuilding our infrastructure, Biden said Thursday during a visit to a Philadelphia shipyard. The White House has dubbed this brick-and-mortar economic growth formula Bidenomics, a phrase originally used by Republicans to jab the president, who co-opted the term as a badge of honor. In addition to his legacy, Biden has also staked his 2024 re-election bid on Bidenomics, betting that strong economic growth and a campaign built around kitchen table issues will ultimately drown out Republicans' culture war outrage. The latest All-America Economic Survey, released Thursday, found that just 37% of respondents approved of Biden's handling of the economy, while 58% disapproved. Only 20% of Americans agreed that the economy was excellent or good, while a whopping 79% said it was just fair or poor, the poll found. Republicans have seized on voters' economic pessimism to argue that Biden is ignoring everyday Americans' ongoing challenges with high interest rates and inflation that has fallen some, but still sits above pre-pandemic levels. With 16 months to go before Americans cast their ballots for president, Biden's political fortunes, for the moment, appear to be improving along with the economy. This report confirms what we've long said: our strong and resilient economy is Bidenomics in action, White House Assistant Press Secretary Mike Kikukawa said in an email. The president's economic agenda is spurring investments in manufacturing and infrastructure that are creating jobs and supporting workers. Wall Street's AI frenzy and strong bank profits send stocks higher. Wall Street's frenzy around artificial intelligence helped push stocks to their best level in more than 15 months Tuesday, along with stronger than expected profit reports from several big financial companies. The Standard & Poor's 500 index rose 32.19 points, or 0.7%, to 4,554.98 in its highest finish since early April 2022. The Dow Jones Industrial Average rallied 366.58 points, or 1.1%, to 34,951.93, and the Nasdaq Composite climbed 108.69 points, or 0.8%, to 14,353.64. Microsoft was by far the biggest single force pushing up the S&P 500. It will charge users $30 per month for its Microsoft 365 Copilot, which Wedbush analyst Dan Ives called a flex the muscles move. Wall Street has sent a select group of stocks soaring this year on hopes that AI will drive tremendous growth in profits and herald a revolution for the global economy. Besides Microsoft's nearly 50% gain for the year, Nvidia has more than tripled. Stocks in the financial industry also drove the market higher. Charles Schwab jumped 12.6% after reporting stronger profit and revenue for the spring than analysts expected. It was one of several other big financial companies to report better results than forecast. JP Morgan Chase, Bank of America, U.S. Bancorp, and Morgan Stanley. Wall Street's reporting season is ramping up. It also reported stronger profit for the latest quarter than expected, and its stock rose 2.5%. But economists said underlying sales trends, which exclude automobiles, gasoline and other items, were stronger than expected in June. A separate report said U.S. industrial production contracted again last month. Altogether, the data seemed to reinforce the heavy bet among traders that the Fed will raise its federal funds rate at its meeting next week, but that could be the final hike of this cycle. High rates undercut inflation by bluntly slowing the entire economy, dragging down prices for stocks and other investments. If the Fed does follow through on expectations next week and raises the federal funds rate to a range of 5.25% to 5.50%, it will be at its highest level since 2001. But inflation has been slowing over the last year, and hopes are high on Wall Street that it will continue cooling enough to get the Fed to stop raising rates and perhaps begin cutting them next year. Economic data broadly have been on the upswing recently, and Goldman Sachs economist Spencer Hill sees it helping growth remain near the top end of the range we view as the sweet spot for rebalancing the labor market without a recession. Could the artificial intelligence explosion save the market and maybe the economy? But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.